When the Bank of England meets later this month, many headlines will be written on the rate hike to 5.5%. For markets, however, that's almost a foregone conclusion, and just as much attention is going to be paid to the announcement of any changes to the quantitative tightening programme. Now this sounds pretty technical, but it's actually hugely important, and it is the unwind of the bonds bought during the quantitative easing programme. And just like QE before it, the precise terms of these sales are watched keenly by the market, with big knock-on implications for the borrowing costs for governments, the borrowing costs for corporates, and the borrowing costs for households. Now, other central banks have been treading pretty gently. Selling bonds on this scale has never been done before, nor has it been tried when bond markets have had to digest the ramifications of both high inflation and substantial rate hikes. As a result, prices for bonds today are much lower than when the central banks bought the same securities previously. So understandably, central banks have been pretty cautious in trying to sell those same bonds back to the market and have been proceeding very slowly. But not the Bank of England. Of all the central banks, the Bank of England has been the most aggressive in terms of selling the bonds it bought during the QE era. Our analysis suggests the reduction has been equivalent to around 7.5% of all outstanding government debt. Now this is a huge amount and is effectively additional issuance that the market has had to digest. Now our same analysis suggests that the pace is much faster than for other central banks. It's about 70% faster than the US Federal Reserve, and it's well over twice the pace of the European Central Bank. It's unclear to us why the bank has been so hasty. The fast pace of these gilt sales has been pushing down on prices, it's been worsening the losses for the taxpayer, and worse, it crystallises what would have been paper losses into a drain that the UK Treasury has to make good. Now, one thing everyone can agree on is that the losses from the quantitative easing programme are huge. Even the Bank of England's own internal analysis is that start to finish, across the whole lifetime of the programme, quantitative easing is likely to cost the state a whopping £110 billion, which is around 5% of UK GDP. Now, rather curiously, for a public institution which is mandated to support the wider objectives of UK government policy, the Bank of England has taken a purposefully disinterested approach to these losses. Deputy Governor Ramsden has even gone on record to state that the MPC, the Monetary Policy Committee, does not take into account profit or loss when making its decisions, including about the gilt programme. Now, moving beyond the rather obvious implications for UK taxpayers, who are probably feeling a bit frustrated by all of that, for markets, the pace of such hefty selling pressure by the UK Central Bank is, in our view, one factor why gilts have struggled this year and struggled to find buyers. Now, historically, UK government bonds were able to attract buyers without paying a premium to US Treasuries, but not anymore. Since quantitative tightening started, costs to borrow for the UK government now comfortably exceed those of the USA. Now, estimating how much of this change in borrowing costs for the UK is purely down to the hurried pace of QT is guesswork and quite tricky to do. Other factors are at play, including, of course, the worse inflation outlook in the UK and any ongoing reputational issues that stem from the Kwarteng budget from Q4 in last year. But as an example, if the extra quantitative tightening that the UK is doing, that extra fast pace, if that accounted for just half the change in borrowing costs relative to the USA, then the extra quantitative tightening, that extra sales that the UK is doing, would be adding around 40 basis points a year to the borrowing costs for the UK government based on 10-year government bonds. That's quite a large figure, and of course has to be borne again by taxpayers. Now, what is interesting for us as investors is that the UK Central Bank hasn't got a great track record in making these sorts of disposals. Many will recall how the reputation of the UK Central Bank took a beating when the UK infamously sold its gold holding at the bottom of the market back in the early 2000s. Now, of course, the situation is a little bit different, and of course, the blame for that is also shared with the government at the time. But there are many parallels with the way that the Bank of England is operating today. For example, similar pre-announcements of sales are used, which acts to depress the prices. Similar disinterest is expressed by the Bank of England in the prices achieved or the scale of the losses crystallised. And similarly, there's a big fear in the market that the pace of the sales could even increase. Ahead of the next MPC meeting on the 21st of September, similar fears exist in the market that the quantitative tightening programme might even be expanded, might even be accelerated further. Now, history doesn't repeat itself, they say. They say perhaps it rhymes. If history is going to rhyme with the past, in our view, the actions of a central bank, the actions of the Bank of England, could again mark the bottom of the market. For investors, with inflation now coming down, with peak rates in sight, this could be an opportunity. And it's one of the reasons why we think that gilts and indeed fixed income are very attractively priced.